My name is Alice and I've been an accountant for 10 years. I used to work in private wealth and I have my own wealth management and financial advisory firm, and I also work with businesses as a chief financial officer. If you're earning a decent income but you're unsure whether you should put your money into your 401k, your Roth IRA, or just pay off debt first, learning this one investing order will change your entire financial trajectory. In this video, I'll walk you through the exact 7-step investment priority ladder. I will show you the math behind why this order maximizes your returns, and I will give you specific dollar amounts and timelines so you know exactly what to do with your paycheck. If you find my personal finance content helpful, make sure you hit the thumbs up and subscribe to the channel. Make sure you also consider joining my newsletter where you will hear more from me regularly on personal finance and business finance. So let's get into it. Before you invest a single dollar anywhere, there is one step that a lot of generic investment advice tends to ignore, and skipping it is the reason why a lot of people end up broke even though they are pretty good investors. And the first step is building up a starter emergency fund of between $1,000 to $2,500. Now, this isn't necessarily a full emergency fund. It's just enough to handle small emergencies without derailing your investment plan. And why this is important is that it prevents you from having to sell your investments during emergencies, and it stops you from going into debt for any unexpected expenses. And I think when you have a little stash of cash, it basically gives you peace of mind so that you can be a little bit more methodical when it comes to actual investing. And it basically creates this habit in you to always cover your bases before you start investing. So this is what the math would look like in practice. If you are just starting out, in the beginning, the first couple months, I would aim to save between $1,000 to $2,500 and put it into a high yield savings account. Right now, there are a lot of high yield savings accounts that are paying between 3 to 4%, which is definitely much more than you would get in a traditional checking account. So let's say you make $60,000 annually and you're able to put aside $500 a month. This means that it will only take you 2 months to build up a starter emergency fund, or in other words, a stash of cash that allows you to move to step 2. What happens when you don't have liquid cash available and you start investing immediately is that if something happens, like when your car breaks down or you need to use that chunk of money for something else, a pet bill, it basically prevents you from needing to sell stocks or sell investments to purchase something else when it's not the best time to sell the stock. In my opinion, it's never a good time to sell an investment strictly because you need the money for something else. You should sell when the time is right to sell. So it's kind of like having an insurance for your entire investment strategy, and it stops you from making really terrible emotional financial decisions or investment decisions when life happens to you. Now, here's a step that's literally free money, and I'm actually shocked as an accountant sometimes when I realize how many people end up skipping this because they think they're going to get a better return elsewhere. So basically, step 2 is contributing enough to your 401k to get the full employer match. Now, typical match depends on your company, of course, but let's say your company matches 50% of your contributions up to 6% of your annual salary. So you contribute 6% of your salary every year. So if that's a $100K salary, then that would be $6,000. Your employer then adds 50% or $3,000. That $3,000 is basically free money or guaranteed money. And that money is put into an employer plan that typically earns at the stock market average of between 8 to 10%. So let's get into some actual math. If you had a $60,000 salary and you contributed 6%, that would be $3,600 a year. Your employer, based on your agreement with them, matches $1,800 a year. And therefore, your total retirement contribution to your 401k for the tax year is $5,400. And then on top of that, you will also get an immediate tax break for contributing to your 401k. Another example, if you make $100,000 a year and you contribute 6% or $6,000 a year, your employer again matches 50% or $3,000 a year. So that's $9,000 a year at 8% growth. So in this example, just from your own contributions, that leads to a portfolio value after 30 years at 8% to be $680,000. The employer match portion of it would be around $340,000, which puts your overall portfolio at, drumroll, $1 million. Now, one of the common reasons why people don't want to opt into their employer-sponsored plan is because they want to pick their own investments because they think that they will earn more from their own investments than from the employer plan. And if you have enough capital to be able to do that, then I think that's definitely a great idea. But at the same time, you also don't want to say no to free money as well when you think about it in the long term. But sometimes with employer plans, they may be selecting or opting into investments with high fees. And yeah, that might be partially true, but at the same time, there's also a cost-benefit analysis to it. The 401k contribution for 2025 is $70,000, which includes both the combined employee and employer contribution limit. The third step is eliminating the wealth killers, and this is high interest debt. So the step that separates smart investors from people that are gambling, and a lot of times people tend to get things backwards, is paying off debts before investing further. So this is some math that makes this really obvious, but if you have high interest debts, such as credit cards, the APR can be anywhere from 18 to 29%. Personal loans can be anywhere from 10 to 18% depending on what prime is and what the bank gives you. Car loans are between 6 to 12% depending on prime rate, your credit score, as well as whether it's a used or new vehicle. And then in comparison, when it comes to returns, stock market averages between 8 to 10% historically. Safer investments like high yield savings accounts, T-bills, or bonds are anywhere between 4 to 6%. So if you're trying to pay off debts, here are some things that I would consider paying off immediately before investing. Credit card loans, personal loans, and car loans, definitely. Now, when it comes to things like your mortgage and student loans, these are generally okay. We consider these to be good debts or okay debts because the interest rate is lower and there is usually an intrinsic longer term benefit to it. So if you had $5,000 to invest and you were also $5,000 in credit card debt, which is accruing at 22%, here are your options. The first option is to invest that $5,000 into an index fund. The potential return in 1 year is maybe $400 to $500. The risk is that you could lose money if the market goes down. Now, if you were to carry a $5,000 balance on your credit card for the whole year, that would end up being $1,100 a year just in interest. So the second option is to pay off your credit card, and therefore you end up saving $1,100. And so the net benefit between the two ends up being $600 to $700 more by paying off your card than investing. So while investing feels more exciting and debt payoff feels more boring, the interest rate arbitrage between the two usually means that debt payoff is the better option financially because you can't really out-invest high interest debt. And every dollar you invest while carrying credit card debt is essentially gambling with borrowed money. So when you're figuring out the optimal order of investing, one of the hardest parts is simply knowing what's actually going on in the markets and what information you can trust. Most financial news today tends to be very shallow, tends to be agenda-driven, or just flat-out noise. You get clickbait headlines, recycled press releases, and analysis that barely really scratches the surface. Now, if you're trying to build a real investment strategy for yourself, relying on that kind of information can lead you blind to risk, late to opportunities, and totally unsure whether you're making the right moves for yourself, which is why I'm really happy to have Seeking Alpha sponsoring this video. Seeking Alpha is the go-to platform for retail investors who want serious, real, and data-driven insights. With Seeking Alpha, you get access to professional-grade analysis on stocks, ETFs, macro trends, and earnings that are written by actual investors, analysts, and industry experts. It helps you cut through the noise so you can make confident, well-researched decisions instead of guessing or following hype. You get access to tools like quant ratings, dividend ratings, factor breakdowns, historical performance data, and deep dive research reports. You can track your portfolio, compare tickers, set alerts, and read the bull and bear thesis arguments side by side so you can see every angle before investing a dollar. They do have some great Black Friday promotions going on right now, so I will leave links down below in the description box if you're interested in checking them out. Now that we have our starter emergency fund and we have taken advantage of the employer match, as well as paid off our high interest debts, we can then focus on more financial security by completing that full emergency fund, which basically just means 3 to 6 months of expenses in a high yield savings account. This isn't so much about returns, it's basically just about never having to sell investments at the wrong time and being financially secure. So this is something you can consider. If you are single and you have a stable job, then 3 months of expenses is good for cash. If you're married and having dual income, then maybe 3 to 4 months of expenses. If you are a single income household, then 6 months of expenses. And if you are on any sort of commission or variable based income where your income fluctuates regularly, then 6 to 12 month expenses is recommended. And so calculating this is pretty simple, listing out all of your monthly expenses, multiplying by the target months you're trying to aim for, and then putting this into something that is actually generating interest, which again is not your traditional checking account that's earning 0.01%. So let's say your total monthly expenses all in is $4,000 and you are targeting 6 months because you're in a single income household. So that means your emergency fund is $24,000, and at the rate of what you're earning could take between 1 to 2 years to build up. I think this is really important because let's say during the pandemic in 2020, a lot of people with emergency funds were able to keep their investments untouched while waiting for the markets to recover. And people without emergency funds actually had to sell at 30% losses just to cover their day-to-day and their bills. We can never predict what's going to happen in the future. And yeah, emergency fund money, cash money isn't an investment, but it really allows you to be aggressive with your actual investments because you'll never have to sell them during actual emergencies. The next level of investing is for tax optimization purposes, and that is that we are going to max out investments to our retirement accounts. This is where you really start to accelerate wealth building, and it's all about keeping the IRS out of your investment returns. So when you maximize all of your tax advantage retirement accounts, it's like you're getting a discount on your investments. So the 2025 contribution limits to your 401k is $23,500. If you're over the age of 50, you are given an additional $7,500, which puts your limit, if you're over 50, to be $31,000. Contributions to your 401k will lead to an immediate tax deduction today. So you pay less tax today, and once those investments grow, it is tax deferred. And any gains that you get on those investments are all tax deferred until you withdraw that money out of your 401k. For your IRA, the 2025 limit is $7,000 or $8,000 if you're over 50. Now, if you make a traditional contribution, you do get a tax deduction today. And if you make a Roth contribution, then you do not get a tax deduction today, but you will never have to pay tax in the future. You may have heard that Peter Thiel, who is an entrepreneurial investor and legend, actually grew his Roth IRA to the billions by his early investments in companies like Facebook and PayPal. And he did all of that tax-free, 100% legal. That is the beauty of a Roth IRA. If you're Canadian and you're watching this, the Roth IRA equals the TFSA in Canada. The 2025 limits for the HSA are $4,300 if you're single and $8,550 for families. You do get a triple tax advantage in that the contributions are tax-free, the growth is tax-free, and any withdrawals, if you use it for the purposes of an eligible medical expense, is also tax-free. So let's do the tax math. If you are earning $100,000 annually, you are in the 22% federal tax bracket. And so your maximum 401k contribution would be $23,500. This allows you to get tax savings, actual tax savings in this tax year of $5,170, which means that net cash to you is the difference between the two, or $18,330. Now, no tax strategy is a one-size-fits-all solution, but one potential strategy for you, and in this example, would be to max out all three before putting money into taxable accounts. Generally speaking, we want to avoid paying tax unless we absolutely have to. Tax advantage accounts are given to us all by the government, encouraging you to save for retirement. And so I would recommend taking every dollar of tax savings available, especially if you are not a business owner. If you're a business owner, then things change. But if you're an employee, then definitely max out all of your tax savings that are available. So the next step in this investing order hierarchy it tends to be where a lot of generic advice fails, because your specific goals tend to matter more than generic investment rules. And that is that we want to fund specific goals with appropriate timelines and risk levels. So what are your goals in life? Everyone has different goals. For some people, it's to purchase a house. And so if that were the case and you're trying to build up a down payment for your house, which can take anywhere from 2 to 5 years, maybe even more, then I would encourage you to put that money into high yield savings accounts, CD, conservative bond funds. You might not want to risk it all in stocks, especially if you have a shorter time frame for investment. If you have kids, then consider a 529 education plan, which allows you to basically invest in your children on a tax-free basis. And you can structure the investment thesis of the portfolio based on the age of your child. Now, let's say that you are saving up for a vacation or you're saving up for a wedding, then that's a really short time frame, maybe 1 to 2 years. And you can put things into, again, high yield savings account, short-term bond funds, and money market accounts. If your next main financial goal in life is early retirement, then you would look into things like taxable investment accounts, aggressive growth allocation, and tax loss harvesting. So where you put your money largely depends on what your next big life and therefore financial goal is. If you are unsure where to put your money based on where you're currently at and what the best decision is for you in the long term, I would highly encourage you to speak to a financial advisor or to your accountant to help you figure out what the best decisions are for you. Now, the very, very last step for building wealth is taxable investment accounts. Now, like I mentioned earlier, I used to work in private wealth. And as an accountant, how you can determine whether somebody has a sizable amount of wealth is if they're actually paying quite a bit of tax on their investments. And this is where you can build serious wealth and financial independence. I would only recommend putting money in taxable accounts once you've maxed everything out, and therefore you have to pay tax on your investments, because tax on investments can be pretty high depending on the type of investments that you're making. Now, if you were trying to achieve the textbook definition of financial independence, retirement early, fire, then consider going anywhere between 20 to 50% of your income into these accounts. But I would say between 10 to 20% for standard wealth building is the minimum to be required, or at least $500 to $1,000 for meaningful growth. And if you follow this order of investments from the beginning of this video to the end, and you start your investing at $2,000 a month, then after 20 years, you will have around $1 million in taxable accounts. Now, your actual tax strategy for this is going to depend on your risk tolerance. Okay, you can put this money into things like stock market index funds. You could have international diversification. You can pick more tax efficient funds. Tax loss harvesting is a very effective tax planning strategy that allows you to minimize the amount of tax that you have to pay today if you have a huge gain that you're expecting from the disposition of some sort of property or investment. So I've given a lot of information in this video just to quickly recap everything and provide an overview of a summary. The first thing we want to do is start our emergency fund, which is just a little bit of cash that prevents us from making terrible decisions. The second thing is taking advantage of your free employer 401k match. The third is to eliminate and pay off all high interest debts. The fourth is to set up a full emergency fund, which can be anywhere from 3 to 12 months depending on your family household situation. The fifth is to contribute to the maximum allowable annual limits of your 401k and other retirement accounts you have. The sixth is to allocate money into specific life goals. And the last is to contribute to your taxable investment accounts. Every step that I mentioned today builds on the previous one, which creates this really unshakable foundation for long-term wealth building. And it's designed to optimize your returns while minimizing your tax and also minimizing your risk, and also factoring into account your long-term life goals as well. By the way, guys, if you're trying to figure out on your own what amounts to contribute to which investment accounts, and you want a step-by-step tracker on a monthly basis to help you budget and allocate your money around, make sure you check out my free personal finance tracker. I will leave a link down in the description box below. If you love this video today, you're gonna love my other video on the top 5 high yield savings accounts that I would recommend. As of right now, these are accounts that are paying up to 4.5% today. Again, if you have the opportunity to put money into an account that can actually generate you a return, that's highly recommended over keeping it in a savings account that's generating you nothing. So if your cash is not working for itself right now, make sure you check out that video up top and let me know down in the comments below what questions you might have about the optimal order of investing. And I will see you guys in the next video. Until next time.